to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. It's amazing. Actually, it's always been amazing. I talk about this quite often. Not sure how many people are actually listening, but that's okay. Just kind of looking around and seeing what's going on in financial markets, and just have a lot of noise, a tremendous amount of noise. And the market's really, it's been pretty horrible this year, and it's down quite a bit. But that's just the way it goes. It's only new to people who haven't seen this before or haven't been watching the markets for any length of time. But I'm telling you, I remember back in 1988, that was when Peter Lynch released, well, I take that back. It was 1991. He was talking about 1987 and 1988 in the book, One Up on Wall Street. And for those of you that don't know Peter Lynch, which is probably about 2/3 of the audience right now, and I'm aging myself, he was a portfolio manager at Fidelity Investments, and he managed this fund called the Magellan Fund. And during his tenure, he ran it for 13 years. He was the number one portfolio manager over that entire time period. And so I wrote a couple books, several books, actually. I think there were 3 in total. And I wanted to read it because I knew who he was. It was the legend. You know, he'd actually outperformed Warren Buffett. That name ring a bell? It's hard for me to believe that Warren Buffett's in his 90s, but then I look around and my next birthday in February, I'm going to be 60. I just can't believe that either. Not until I look in the mirror. Yeah, I scare myself every single day. I go in, look in the mirror, and I think somebody broke into my home. It takes me a minute to realize that's me in the mirror. Some old guy broke in my house. Anyway, so he was talking about how volatile stocks were, and I'm reading it, and Warren Buffett wrote about how the average stock has about a 50% average range per year. And I'm still surprised because I've been talking about those books this entire time, or the entire time that I've been on the radio. But I started in 1996, which is hard to believe. But, and I was talking about this the entire time, and I still come across an awful lot of people who just don't realize how volatile stocks are. In the long run, stocks have outperformed just about every other investment on the planet. And in the better than bonds, better than gold, better than real estate. Now, there are people that have made billions in real estate. They were developers. It's not the same thing. The passive investors in real estate have done pretty good if you go back over really long time periods, but over the past 5 or 10 years, not as well. And by the way, when you invest in real estate, if you're going to outperform the stock market, you're going to work hard. You're going to earn that money. I can visually see all the people that invest in real estate nodding their heads going, yes, you have to work hard. But so as far as a passive investment goes, the stock market's been one of the best. Valuations on it they're actually slightly high now, even after the market's come down quite a bit. Not nearly as bad as they were just a few months ago. So that's actually a good thing, especially if you're relatively young or if you're reinvesting dividends. That's a good thing for you. All those dividends are buying more shares at cheaper prices. And that's a concept that, you don't hear a lot about in mainstream television anymore. I guess they felt like it's too old-fashioned, but it's still true. Doesn't matter how old it is. It's still true. When you're investing in funds, you're in your 401k plan and you're putting money in there, you've got a plan where you're taking money out of your check and putting it into a stock fund. Don't get upset. These low prices are not going to stay here forever. And every dollar you put in the market buys more shares because the prices are lower. And when the market goes up a lot, if you're reinvesting, let's say you're just reinvesting the dividend. When the market goes down, the dividends are buying more shares because they're on sale. They're buying it at cheaper prices. It's like, let's say you're going to put $100 into the market, and the stock that you want to buy is $50 or is also $100. Let's say it's $100. So you're going to take $100. You're going to buy one share, and 6 months from now, it's selling at 50, which is pretty common. It's not completely common for it's pretty common for mid and small cap stocks. Large cap stocks, that range probably down to 75 up to 125. That would be your 50% range for a year, 50 points. Anyway, the bottom line is that $100 that you put in, you bought one share last month. Now it's down to 50. Guess what? Now you're going to get two for one. And the stock market is the only market in the world where people are literally crying when they have a sale. When stock prices go on sale and your money is buying a whole lot more shares, people are upset about that. And there's nothing really to be upset about. I mean, you're getting better deals. If you have a fund, let's say one of the high-quality dividend funds, the dividends are reinvesting every month. Those dividends are buying more shares because the prices are lower. That's a good thing. That's a really good thing. By the way, that brings up a really important topic. When an awful lot of people get to retirement age, they say, I don't want to reinvest my dividends at all. I just want you to pay them out. You know what? That's actually probably not the best idea, because you will miss the opportunity to buy more shares at lower prices. Okay, because if you're spending the dividend and the share prices are dropping, well, that's, it's very uncomfortable as well. But then you're not getting the opportunity to reinvest at those lower prices. What I would suggest to do instead is take 4 or 5%, whatever that number needs to be, out of the account somewhere in January and just draw that down over the entire year, so that the dividends that you're going to get are going to reinvest just in case the market goes down. You will still be buying. You'll still be buying shares. That's really important. So I'm going to kind of leave that topic alone for now. We'll come back to it a little bit later. But normally I talk about the economy first, and then I start talking about financial markets. But I'm going to go to the economy second today. We will get to the fixed income area before the end of the show. But economy. I pay a lot of money for some pretty good services, institutional research. And I'm amazed. I am amazed at how strong the economy is. That's why the Fed's raising interest rates. That's why they're looking at not backing off. Now that Russia's playing games, and in Saudi Arabia, they're cutting the supply of oil. You know what? Go ahead. Go ahead and do that. You're digging your own grave, because the more you do that, the more we are going to rely that the more money goes into the development of cars who run on hydrogen, cars that run on electricity. Yeah, those two industries are huge. You're boosting the solar panel business because you're making it so expensive to drive the cars that those are the alternatives now. And in the long run, yeah, you might get some money in the short run. In the long run, it's going to cost you. But, I guess that's inevitable anyway, just because of climate change and whatnot. But it just drives me crazy to see how countries try to take advantage of the rest of the world. But, it's been that way since the beginning of time. And one of the reasons that the United States has done so well, incidentally, is because our money supply and how the Fed has managed that. They do a good job managing interest rates. Should they be raising interest rates now? I don't know. Are they going to? Probably. Is that good for stocks? It makes it hard on stocks. I mean, think about it. Most companies have to finance their inventory. Well, not most, but a large percentage of companies have to borrow money to buy raw materials to turn it into a product to sell it. So when they have to borrow money, and a year ago they were paying next to nothing, okay, and now they're paying 5 or 6%, and it's in the billions, or at least hundreds of millions. Mostly, a lot of them are in billions. That's expensive. And what's 5% of $1 billion? $50 million. So that's a lot of extra money that's going out the window that's not going to the bottom line. That's one of the reasons that stocks have a tendency to go down when they start raising interest rates, because a lot of companies have a lot of short-term debt and they refinance, inventories. That happens all the time, especially in the Rust Belts. And we still have a bunch of heavy equipment manufacturing and that kind of stuff. Not as common as it used to be, but that hurts. People that are going to look to buy a house, if you were close, for qualifying for their house payment, and then they raise interest rates up by 0.5% or so, that could kick you right out of the market. You may not be able to get that house financed. So it has a big impact on that. And we'll see. We'll see what's going to happen. I'm still surprised by how strong the overall GDP is. It'll be really interesting. But right now the Fed is raising rates. They're trying to squash inflation. And most of the inflation, incidentally, is coming from supply chain issues and the fact that there's a war. And I just don't know that you'll stop a war by raising interest rates. That's just, I don't know. I don't know that can happen. Maybe it can, but maybe they're saying, we don't care. There are all these other issues that are going on, and we need to slow it down. Because when you do get super high inflation like you do now, there's actually I used to do this little experiment at most seminars. I'd have people raise their hands. How many of you would like to see your money cut in half over prices doubling? And almost nobody raised their hand. Okay, how many people would rather see prices double than see their money get cut in half? Everybody raises their hand. I'm like, you realize you're in the exact same position. So if prices double and your assets don't grow, it's the same thing as your money getting cut in half. There's no difference. It's just a preference in how your purchasing power is going to drop. And I understand, and that's one of the reasons that the government keeps printing more money, is that they understand that the public would prefer that. We prefer that prices double. We hate it when we see the value of our assets get cut in half. And I understand completely. So it's just one of those things that it is what it is. And they're going to continue to raise interest rates. Right now, interest rates on fixed income products are at the highest levels they've been for over a decade now. I have to go back and double check that or fact check it. And so that's really, it's kind of wild that you're seeing I didn't think we'd see these interest rates again for a long time. And so if you're looking at fixed income, you're looking at things like treasury bills, I think, or CDs. I think that's a good idea. If you're looking for bond funds, you only want to go super short-term bond funds. You want there's a number there that they use. It's called duration. And you don't have to know what it is. You can Google it if you want. But you want a duration of less than 2 years right now. Okay, so those are the types of funds right now that they don't go down a lot when interest rates go up. If you look at what the 20-year ETF bond fund has done over the past 18 months or so, it's down almost as much as the stock market. I mean, think about that. And it's holding government bonds. We'll talk about why that is when we come back. This is Bill Bullington right here on 1420. Stay tuned.
When I sit back and imagine life without you, I can't fathom how I ever thought I'd make it on my own. And there's at least a million reasons I'm still standing here believing you're my comfort, you're my healing. This I know. When you can't see the wind when it moves the leaves from the bottom to the top of the tallest trees, you are everything that I'll ever need, and they can't take that from me. Oh, I feel it in my heart, I feel it in my soul.
And we're back.
Raining for days. My world is a flood.
Yeah, sometimes when it rains, it pours. Just remember, the storm is darkest right before it gets pitch black. I'm just kidding. I forgot what that is. I forgot what that saying is. Darkest before the dawn, something like that. Anyway, that seems to be what. Pardon me? Oh, the calm before the storm. Yeah, there you go. Yeah, do you know that in really bad storms, in the middle of the storm, like hurricanes, that there's actually calm air, and it's the outside of the storms that the planes really got to worry about, that have to fly in that stuff. And I remember, I don't know if you guys remember Dick Goddard. He was a weatherman for years and years and years. That guy came to my school when I was in the 6th grade. He must have lived to 120. But he came to I was in the 6th grade. He came to school. He was a meteorologist in the military. And one of his jobs was he had to get in one of these planes that would fly literally through the worst storms that came up. He would have been going through this one here that just hit Florida. And they would have to fly through it, and they would take all these measurements when they were there. And that's where I learned about how calm it was in the center of the storm. Kind of interesting. Kind of like being in the stock market. You need to be calm in the center of the storm. You see things swirling around you, and you still have to remain calm and keep your composure. And you'll come out on the other side pretty good if you can do that. And everybody's a little bit different, by the way. We talk about this quite often, and I just got through another compliance. I put myself through these audits like every other year or so, just to make sure I'm staying compliant. And we talk about risk tolerances, and I've gotten my compliance firm to add to my risk tolerance questionnaire one simple question that I think is probably, it's my opinion, that it's the best way to figure out what your risk tolerance really is. And this is the question. Imagine your portfolio is invested and you're down 15%. Are you upset? I mean, are you to the point where you're losing sleep? If the answer is no, let's take 20%. Well, literally write down the value of their portfolio, all their savings, take off 15%. Are you upset yet? Take off 20%. Are you upset yet? What number is it where you think you might be losing sleep? Mine's 40. If I'm down 40%, I'm probably a little worried about that. Okay. So 40%, if I'm going to double that number, that means I can put up to 80% of my money. That's our methodology, by the way. We can double the decline tolerance, and that's what we're going to put in stocks. And not that that's actually going to stop right at 40%. I mean, I understand it could go lower than that. But if you look at the number of times that stocks have been down 50% or more, it's probably a dozen. I think you have to go back to the Depression to find where stocks were down more than that. And during the Depression, we didn't have an FDIC. A bank could literally call your note in 30 days. You had 30 days to pay it off. That's one of the reasons it was so bad. They also had no regulation over their trust departments, which were buying stocks that the banks themselves were bringing public. So they're bringing these companies public and sticking them in their client accounts. That's not good. But, well, it could be good, but very risky. So anyway, I do this all the time. So many things pop up in my head that I can't even remember the path I was going down. So anyway, we're talking about, risk tolerance. If you have more than 50% of your money in stocks and you're not looking at the possibility of a 25 to 35% decline in that account value, then I think you're making a mistake. Because hopefully it doesn't happen, but it's happened multiple times during my lifetime. And if it were to happen again, I'd hate to see you upset to the point that you were just pulling out of the market. And I see that a lot. That is such a bad thing to do. I mean, it's just horrendous. And I've seen all these reports. In fact, I've got one with me here that talks about, focusing on the long run, not trying to pull out. Now, I've seen a ton of this. And every time I bring something like this up, by the way, what happens if you missed the 5 best days? Let's see here. And this is going back from 1980. You put $10,000 in and you stayed in the S&P 500 the entire time period, didn't pull any money out, didn't have to pay taxes. By the way, good luck with that. The 10,000 would be over $1 million. If you happen to miss the 5 best days during that entire time period since 1980, that $1 million drops to $655,000. If you were out of the market the 10 best days, it drops down to $472,000. So from $1 million down to $472,000 by missing the 10 best days. If you miss the 30 best days, it drops to $171,000. Can you believe that? It drops from $1 million down to $171,000 because you're out of the market on the 30 best days. Missing the 50 best days, you might as well just put the money in a money market account. Literally. Because it only grew to $75,000. And over that time period, a money market account would have done better than that. That blows my mind. Not in the last 10 years, by the way. Money markets the last 10 years have paid nothing. So that's even what that bad period put in there. Every time I brought this up, I have people calling me up and emailing me saying, hey, well, you should see what happens when you capture the 10 best days. And when you avoid the 10 worst days. Yeah, when you avoid the worst days, your return goes up even more. Yeah, but see, here's the problem with that. You actually have to have a crystal ball that works to figure that out. You have to have a crystal ball that works both ways. It's got to tell you what the worst 10 days are, and it's got to tell you when the best 10 days are. In other words, you have to know exactly what to do at the exact right times. And if you don't, by the way, your returns are going to come up significantly lower than they should be. So that's if anybody wants to see this, you can go to my website and request it. Just say, I would like to see that article on timing the market, and I will be glad to send it to you. Anybody that's already signed up for my newsletter gets it automatically. So this is one of the stories that went out this week. And I'm telling you, I've seen so much stuff, and I still get these bright-eyed, bushy-tailed phone calls from people who think that, I found something new. No, you haven't. You have not. I hate to be so dramatic, but I'm trying to make a point. I spent the better part of, 4 or 5 years learning to code and buying data. It was super expensive to try to do the same thing that a whole bunch of hedge funds have done for an incredibly long time period. And that's figuring out how to try to time the market. That's how I know that the resistance is futile. Don't try and do that. I mean, even when it worked, it didn't work like you wanted it to. There were more losing trades than there were winning trades. It still made more money, but the amount of time that you would have to put in for the increase in returns that you might have gotten, not worth it. I'm telling you. And you don't have to listen to me. And I know 9 out of 10 of you won't. You'll be just like I was. You're going to go down that path, except that you're not going to spend the money on the software. By the way, that $5,000, that was in 1995 dollars. Yeah, a lot more money back then. And the computer I had to have to run that was $3,600. I remember that stuff like it was yesterday. A lot of money back in the mid-90s, before some of you were even born. And then I had to pay tutors to teach me how to write code. So it was I really wanted to know. I mean, I really wanted to know. And you know what's really funny too? I used that same software to be able to do some individual momentum investing. And then as the software got better, got more expensive. I was able to build even better models. And then this little thing called an exchange traded fund came along. And these guys were doing the same thing I was doing on a much larger scale. And now I don't have to do that stuff anymore because they lobbied and got all their short-term capital gains converted into long-term capital gains. You don't even have to report until you sell the shares for most of them, which is mind-boggling. And you would be an idiot to continue to do it the old-fashioned way. If you don't know how to identify those funds, it's, give me a call. Or, just give me a call. I won't tell you it's easy, though. I mean, it was never easy. Making money in stocks has never been easy. It's simple, and the simple stuff tends to work fairly well. That's one of the things I got out of doing all that testing. Is that, by the way, the people at Dell, their salesman had me on speed dial. The minute they knew that that was my key, 25% improvement in speed. If it's not 25% faster, I don't want it. I'm going to test it, and I'm going to send it back. And so they would call me, like clockwork. And it was so funny. For about 4 years there, I was buying a new computer, probably once a quarter, once every 6 months, because it would get faster. And it would take what normally took an entire weekend when I first started doing it. That's how long it took to do that many iterations. It would change one of the variables, run the program again, change the variable, run it again, change it, run it again, and it's doing it over decades worth of data. Okay, so over a weekend, I just let it run, and I'd get about 1 million simulations in a weekend. And then it got to the point where it was coming down to 5 or 6 hours. I was going, wow, that's amazing. And then it got down to less than an hour. And I'm going, holy cow. And that's when the ETFs got started. They came in, and now if you can literally, if you can come up with a strategy that's halfway decent, there's at least 4 or 5 funds that are doing that exact thing. And you know what the advantage is? First of all, if you can recognize what it's doing, what are those key, they like to call them factors. What are those key factors that have shown to produce above average returns in the long run in the past? Okay. You're not allowed to project that out into the future if you're sitting in my shoes. But what has worked well? Which factors have worked well in the past? Can't guarantee that they'll continue to work. That's why you really need to take some logic, use some common sense. And even then, things are going to change. They will change over time. And you'll watch, if you follow the markets closely enough, you'll see funds coming out that are trying to take advantage of changes that are occurring in markets. And I know this is not what most of you like to sit around doing in your free time, which is why I have a job. I like doing it. I do it for a living. And it's fascinating. It's fascinating. You know what would be really funny? It wouldn't be that funny, actually. But if you showed somebody the inside of an exchange-traded fund that had some basis in momentum and was holding only 50 stocks, when you saw the turnover inside, it's kind of like watching sausage being made. Now, I've never watched sausage being made, because I've heard of that and I've heard the description. Not really interested. Maybe that would be a good YouTube video. It's probably out there. Somebody's making sausage somewhere. But I understand what they're saying. And I'm telling you, it's the same thing with a stock fund. You do not want to see what's going on inside. Because if you do, it may scare you out. Now, you're going to need some of this to be able to make money. And we'll talk a little bit more about that after these commercial messages. This is Bill Bullington on 1420. Stay tuned. I'll be right back.
It's up inside your head. You got a voice that says you won't get past this one. You won't win your freedom. It's like a constant war, and you wanna settle that score, but you're bruised and beaten, and you feel defeated. This goes out to the heaviest heart. Oh, to everyone who's hit their limit, it's not over yet, it's not over yet. The other day I was thinking to myself, made a list of all my mistakes. Oh, I wish I could have run to you and tell you all about my heartbreak. And I wondered to myself, wait a minute, am I even on the right path now? Had a couple wins, but I got knocked down. But I know that you are here right now, and you say, ooh, sometimes you lose, sometimes you win. Ooh, you gotta get up again.
Wow, what a perfect song. That's exactly what investing is like. You're going to get knocked down, you got to get right back up. Just keep getting up. And it's amazing how well that works over time. Not very complicated. And that's one of the things I really feel bad about with for people out there, because I started studying some other book, and I was halfway through this one book. It's 600 pages. And this guy did a lot of the same things I was doing over the several years that I was developing models on my own, because these didn't exist at the time as investment options. So the book is, I like it. It's fascinating to me. It's literally all statistics. Can you imagine being excited by 600 pages of statistics? Yeah. I couldn't have imagined that either when I was younger, but to me, it's really interesting because it goes deep into the psychology of investing, and what you think should happen typically is the opposite of the way it actually happens, which is why people get so upset, and they start, when markets are down, instead of saying, hey, wait a minute, this is probably a good thing. First of all, it keeps markets from getting super overvalued and staying super overvalued. So you have a 10-year negative return period like you did through 2000 through 2010. Anybody remember those days? Not a lot of people remember that, actually. But when I was coming up in the business, there was a period through the late 1960s all the way up through 1982 where the Dow Jones was flat. Well, it wasn't flat. It was really volatile the entire time, and it ended up where it began. Now, back in those days, you had a dividend yield that was fairly high on the Dow, with like 4 or 5%, somewhere in that neighborhood, maybe 6. But long-term government bonds had gotten up to a peak of like 15%. A lot better than a 5 or 6% dividend with, assets that are fluctuating like crazy, right? So a portion of your portfolio belongs in something safe like that. In fact, one of the things that Peter Lynch, I was talking about it earlier on this show, he had the best track record of anybody in the stock market for, I think it was a 13-year period. And what was really funny about that is he had almost half the money in bonds. And when I read that in the book, I was like, what? What are you you're supposed to be in stocks, not bonds. And so I looked it up, and sure enough, we wasn't exaggerating. So, and I'm looking at it, I'm going, wait a minute. Okay, so he bought bonds when they were down around 14, 15%. If he would have bought them at the exact right time, it would have been about a year and a half earlier. That would have been a better buying price. But he did make the shift, and he went in a big way. Because when interest rates come down, when the bond you're holding is paying $150 and the new bonds are only paying $80, which is still really good, by the way, what do you think is going to happen to the bond you're holding? Its price is going to go up. So, and he said he wasn't a stock fund. He was actually a capital appreciation fund. That's one of the reasons you need to read the prospectuses. Because if you didn't read that, you wouldn't know. Not that it would have helped you a lot anyway, but it is good to know. I think the more you know about what your funds are doing, the more calm you'll be when you see declines. If you've gone back and looked at the performance on your funds during declines, that helps you. Helps me. I go back to it all the time. Actually, I'm doing it on a daily basis. And I'm typically showing clients, here, look, this is what we're doing. Here's what it's done over the past 10 years. You get to see a whole bunch of volatility over that time period. Still really good returns. Still really high relative to stock or relative to CDs. At some point in time, CDs may, in fact, get to a point where we're going to do the Peter Lynch thing. Absolutely. If it gets to a point where interest rates are incredibly high, the economy starts to stall out, and the Fed's getting ready to cut, and they're talking about cutting interest rates. Well, you know what? That might be a really good time to buy some treasury bonds in your portfolio. It's not there yet. We're not even remotely close to that yet. But down the road, if we're going to learn anything from Peter, and a lot of people did a lot of that stuff. So, the asset allocation funds, actually, most of those are run by computer today. That's a little harder because they have they've got these algorithms, and they're only going to buy a certain, like if you look at the BND, that's the Vanguard ETF for the bond market. It's been getting crushed. It's not getting beat nearly as badly as the 20-year TLT. That's an ETF that invests in long-term treasury bonds. Look how much that is down. That's why this is important. You need to know this. The TLT has a higher yield. Its dividend is higher than most other things. That's not going to make you feel really good if it drops another 10 or 15 or 20%. You're getting a 3%, 3.5% dividend. Woohoo! So for 3.5% or 4% at the most, I think it's 3.5%. I'll have to double check that. Anyway, for a relatively low interest rate, you're going to risk 15 to 20% of your principal? Does that seem smart to you? Doesn't to me. And you know what? If all you were looking at was, hey, these are government bonds. When you put bonds in a fund, you just turned it into a stock. That's what you did. You didn't know it because you didn't listen to this show. But when you put bonds into a fund, you've just turned it into a stock. And it's going to fluctuate every single day. Not like CDs and treasury bonds fluctuate, but they mature. They have a maturity date. And on that date, you know exactly what it's going to be. Okay? That's the big difference between using a bond fund and individual bonds. I would prefer the individual bonds if I could. If they're available and the interest rates are good on them, I'd much prefer that. But if not, you need to really read those prospectuses. If you see a yield that's higher than 2 or 3% on a fund, you better read it really carefully because you don't know how much risk they're taking. So, again, one of the reasons I have a job. In fact, I was just thinking about that the other day. I remember way back in the day when I was studying for the Series 7. That's a license for stockbrokers, basically. And half of the test was on bonds. Literally, half the test was on bonds. And I'm thinking, holy cow. So you're putting hedge funds, mutual funds, closed-end funds, stocks in foreign countries, all of that makes up the other half. And then that half is on bonds. That's how much material, that's how important that is. Today, nobody knows that stuff. They don't really talk a lot about it. There's not a lot of money to be made on an investment advisor's side about knowing that. And my philosophy is I'd like for you to know it because it's going to help you during those rough markets to ride them out. So you will make more money because you don't panic because you don't have all your money in stocks. So, yeah, I think they should probably have 60 or 70% of the test in bonds because you need to have bonds. You got to have some. I mean, it depends. I mean, if you're in your 40, let's say you're 45 or younger and you're looking at 20 years before you retire, probably not so important. If you're above the age of 55, you should probably have some bonds in your account unless you are a billionaire. Elon Musk doesn't need any treasury bonds. Neither does Warren Buffett. Neither does Jeff Bezos. Those guys, they can do whatever they want. They could actually just invest in a dividend-paying ETF and probably do better than 95% of the assets that they're holding right now, which I think is really funny. Actually, Warren Buffett's, he's probably ahead of everybody else. But the other guys, it just blows my mind how somebody with a lot of money really doesn't know a whole lot about investing And people think that rich people get rich because they know a lot about investing. No, most rich people get rich because they do very well in a business, 1, 2, or 3 industries. And if you look at the returns on a lot of their accounts, they're no better than anybody else. It's just that they started out with a whole lot of zeros behind the money. And if you've got a whole lot of zeros behind the money, anything over 3% looks really good. And I just think it's funny. I've seen a million portfolios like that where, well, not a million, but I've seen a lot of portfolios, people who make a ton of dough in their fields, own big businesses. You look at what they're invested in, you're like, oh, wow, that's, you're not doing nearly as well as the average Joe is. And it depends on the average Joe, by the way. The ones that listen to my show. I'm just kidding. But, yeah, it's very difficult. It is, and I don't mean, I think sometimes I come across as maybe too glib, but reality is it's tough, and I'd rather laugh than cry. That's how I feel. I'd rather laugh about it than cry about it. And I know a lot of people don't feel that way, and I'm making all those people upset. The ones that aren't happy unless they're miserable. Just kidding. I am just really off the rails today. But the bottom line is, tomorrow's, if they keep printing money, the way they are, sooner or later, that money makes it into the market. Sooner or later, that makes it into a box of Pampers. When you keep printing money, it's going to go into Pampers because they're going to raise prices on Pampers because their prices are going up. And they need to defend their profit margin. Same thing with dishwasher fluid. You look at Cascade. I forget. I think, is that made by Clorox? I don't know. Clorox makes a lot of cleaners. When they get the price increases, that's one of the reasons that prices go up. They're trying to protect their profit margin. And if they protect their profit margins and they have to raise prices, but there's enough money circulating because they've put it out into the circulation for people to be able to afford those things. And most people are going to probably wash their clothes, I'm assuming, even if it gets, economy gets really bad. The people are still going to eat. People are still going to drive cars, houses. They're going to buy housing. There are tons and tons of products, materials for all that stuff. That actually blows me away. Do you ever just go into a Lowe's or a Home Depot and walk around and look at the number of products that are in those stores? Or go to a Walmart. I mean, how on earth? I'm so impressed that they can track all that. That they track all that stuff. It just blows my mind. And it blows my mind how many companies there are out there across the world that are making those things. So all that stuff has to be done. They've got to be able to do it. It's got to pay off for them to be able to do that. Otherwise, they go out of business. And that's one of the things I kind of like about the market. It literally will pare down companies who aren't contributing. If they're not adding value, they have a tendency to go away. Occasionally, a good company just has some bad luck and goes away. And, okay, that's right. I've just got a note here. Cascade is a Procter & Gamble company. Product, rather. Yep. And by the way, the Ivory soap was one of the first Procter & Gamble products, too. And I always laugh because I see ads coming from the 1890s for that. But, yeah, that's the world we live in. If you're there, one of the reasons I'm talking so much about this is because it's pretty necessary to defend against inflation. Inflation has been better. What's the word I'm looking for here? It's kept up with by financial assets in stocks better than most other categories. It's done better than cash. It's done better than CDs over the super long run, although there is a place for all that stuff. It's done better than real estate over long time periods, but there's a place for real estate too. Everything's got its place. You just have to kind of get together with somebody who can help you separate that stuff out or at least tell you where it is in your portfolios and that, yes, you are covered there. and try to keep you in balance with what your own tolerances for risk are. You really need to do that. And I mean, I worked for years to get that questionnaire down to the point where, first of all, it's pretty blunt. How much of a decline are you willing to put up with? When you come up with that number, okay, stock market's been down more than 50% more than once in my lifetime. So that's the number we're going to use. You come up with a 25% decline tolerance. 2 times 25 is 50. You probably shouldn't have much more than 50% of your money in stocks. See how easy that is? You don't have to go through 50 pages of questionnaires. You can just think about that really hard for about 5 or 10 minutes, come up with an answer. And by the way, you can always change the answer too. I hear the music. That means they're getting ready to kick me out of here. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. Have a good weekend, everybody. Good luck, good investing. Go to my website at bullingtoncapital.com if you want to reach out to me. And I'll talk to you again next week.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420. The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.